David mentioned that I was talking about a concern on taxes. I have some concerns on taxes. This was a graphic I got. It shows if the top 1%, this has been in the news the last year or two, the U.S. transferred their wealth into land, they would own this much of the U.S., the next 9% would own this much, and the remaining 90% would own the bottom part. Now, I'm willing to bet that this was probably put together by somebody that might be slightly left-leaning, but it did surprise me that the part that they gave the 90% included more or less all the oil and gas that the U.S. actually owns. Nevertheless, the 1% are easy targets, both in the media and, quite frankly, I think for politicians as well. So even here in the U.S., you can see that the top 1% now pay almost 40% of all taxes, up from roughly 20%. But unfortunately, the story you hear, which is also true, is that just before the Depression, almost 19% of the income of the U.S. was in the top 1%. And then that shrank to 7.3% by the 70s. Now it's at 19.3%. And in Canada, it's only at 10.6. This 19.3, the highest ever recorded. So the concern here is, will this translate into higher taxes for wealthy people? I would argue the answer would be yes. Now, if you think that just because Obama's not very popular right now, and maybe the Republicans will win the next congressional battles coming up in the next few months, consider that Republicans actually love taxes more than Democrats when you actually look at the record. So here's a record of tax rates in the U.S. So you can see Eisenhower killed everybody with a 91% marginal tax rate, and Nixon had 70%, even Reagan had 50%. So Bush finally got it down to 35%, but that's probably because he wasn't thinking the day he signed whatever he had to sign to do that. And just curiously, tax rates have also been higher in Canada. Does anybody know what the highest tax rate in Canada was? Marginal tax rate? 60, 70? Hands for 70? 80% in 1971. So the fact is that we've been here before, and it's not impossible to get there again. I would like to think that's not going to happen, but prudent planning would suggest that you really want to pay attention to this side of how you manage your portfolio and your affairs generally. So I want to just finish up with a couple of thoughts about what's on your bucket list. When you're looking at, when we're sitting down with our clients and looking at their objectives, there are a lot of things that could be on their bucket list. They could want to leave a family legacy. They want to buy recreational property. They want to travel more. They want to look at new avocations. This guy's an aging rocker. I always thought that I could be an aging rocker as well, except for the fact that I'm bald and I can't sing. But absent those limitations, I thought I'd have a good shot at it. And of course, philanthropy is also a potential legacy issue as well. Those could all be on your bucket list. So let's take a look at what planning does to figure out how much capital you need for what your lifestyle is going to cost and what might be left over and what makes a big difference. So we're just going to look at a couple of factors here and make the following assumptions. We assume that a person's retiring, they've got $3 million of investable assets, they've got a 15% average tax rate. Notwithstanding what I just said about taxes, we're comfortable, at least in this environment, we can keep a couple's tax rate to that average level with that kind of portfolio. But let's say their returns fluctuate between 2% over inflation to 5% over inflation. Well, the question is, how much money do they really need? They want to preserve their capital over time. All right, so there's the numbers right here. At 2%, if they take more than $68,000 a year after tax, they will start to erode their capital. This goes to $93,000 a year at 3%, $120,000 at 4%, and $145,000 a year that they can spend at 5%. So a 3% difference in return makes a 150% difference in how much they can spend for their entire lives every year. So one of the reasons we focus so much on reporting to you about what your actual returns are and where the cash flow is coming is that this is the critical issue. Your real return after inflation is what's going to drive where your capital can be spent. we can reverse this and look at it from a different perspective. Using the same assumptions, let's say we're just going to do this from an income perspective. We want to spend $150,000 a year. So what does that mean? Well, if we make 2%, we're going to need a whacking great $7.7 million of capital. It shrinks to 5.2 at 3%, 4 million at 4%, and 3.2 million at 5%. So again, 58% less money is required. When we put these two things together, the real question is this. With a proper plan, you have obviously additional capital for other items on your bucket list that may be important to you, the things that you really want to do. So again, it's very difficult to know how much spare capital you have without going through the analysis. So overall, the the observations are this. The first thing is, I think it's really dangerous to look at predictions, and it's, when Rob and I are talking about these things, our predictions for the future are to look at trends. We're pretty comfortable that at some point interest rates are going to normalize and rise. We're not comfortable exactly when that's going to occur or the quantum of that. We're prepared for looking at portfolios to deal with that as these events unfold. There are lots of low-risk fixed income approaches. Insured annuities is just one of several that can increase yield without having a significant increase in the risk of the underlying asset. Real estate is a great complement to equities. It's not a replacement for equities. It's a great complement for equities. And we do see a future for natural gas, and it is one of the areas that we're focusing on both our private equity and our public equity portfolios. And finally, you create a plan before selling or investing, because that's what drives how the portfolio should actually look. And that fundamental issue, coming back to what Buffett said, that's the key driver for portfolios. So with that, I think we're finished our formal remarks, and I don't know, David and Rob, if you want to come on up. I want to thank you all for coming tonight. It's been great to be here, and really appreciate you coming. Thank you so much.